Hi, I'm John Basalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview. Hi, John Basalis here from Realosophy Realty. So right now I'm going to be speaking with Doug Hoyes. Doug is the author of Straight Talk on Your Money, a fantastic book. He's a regular commentator in the media on debt and insolvencies, and he has a fantastic podcast, Debt Free in 30, where he helps people find the right solutions to their debt problems. Also very active on Twitter. You should definitely follow him. Let's jump right into my chat with Doug Hoyes. All right, Doug, thanks so much for joining us today for our Toronto Real Estate Summit. Really great to get some of your insights into things that you're seeing on the ground in your business and where you think things might be heading in the future. So thanks so much for joining us today.
Great to be here, John.
So maybe let's just start off. If you can maybe tell us a little bit about what your company does. I mean, that kind of might help set up our discussion, give people a little background in terms of what you do and the type of business you're in and kind of what you see day to day.
My company's name is Hoyes Michalos and Associates. It was a pretty original name because it was Doug Hoyes and Ted Michalos who started it. We started the company in 1999. We both had a background working for the large accounting firms for about, well, I was with KPMG, PricewaterhouseCoopers for about 10 years before starting Hoyes Michalos. We're CPAs as well as licensed insolvency trustees. And our entire focus is on helping individuals with debt. So we don't do any corporate insolvency, corporate restructuring, anything like that. The typical person who comes to us is a typical Canadian. They've got a bunch of debt, credit cards, bank loans, income taxes, payday loans, that sort of thing. They've got more debt than they can ever hope to repay. So the two solutions we offer are personal bankruptcy and consumer proposals. And these are legislated solutions. They're contained in the Federal Bankruptcy and Insolvency Act. I think everyone conceptually understands what a bankruptcy is. A consumer proposal is exactly that. It's a settlement that we work out with your creditors. So, and I'm happy to give you more details on that. And we've been doing this, as I say, for over 20 years. We've got offices throughout Ontario. Although now here we are in 2020 where we're doing a whole lot more stuff using things like Zoom video and meeting with people remotely. So that's the current environment we're in.
So maybe if you can just unpack at a high level, maybe for those who aren't familiar, how a consumer proposal is different from bankruptcy.
Well, in a bankruptcy, you essentially lose your stuff. So if you have any investments, any equity in any, a house, for example, then in a bankruptcy, you lose that. And I'm oversimplifying slightly, but that's the gist of it. So if someone was to come to me and say, well, I own a house, and if I was to sell it, I'd be able to generate $50,000. So there's $50,000 in equity in the house after, paying for real estate commissions and selling costs and so on. I would say, well, if you go bankrupt, you're either giving me the house or you're giving me $50,000. So in that scenario, a lot of people would say, well, I got $100,000 worth of debt. I can't service it. I'm not able to refinance the house. I can't borrow enough to deal with it. Why don't we offer a consumer proposal, which is an alternative to bankruptcy? So in that scenario I've just given you, we would go to the creditors, everybody you owe money to, and we'd say, look, here's the deal. If I went bankrupt, you guys would all share in $50,000. How about I make a proposal where I give you $60,000? Here's the deal. I'm going to pay $1,000 a month for 5 years. That's $60,000. So the creditors would look at that and they go, well, that's more than we'd get in a bankruptcy. So they would be favorably disposed to a deal like that. Whereas the person who owes the money, the debtor, says, well, I get to keep my house, which is, I guess, a good thing. and I can actually afford to make those payments. Now, I just made up those numbers. Obviously, everybody's situation would be different, but that would be a classic example of why someone would file a consumer proposal. The other obvious example is that in a bankruptcy, you have to report your income every month. The more you make, the more you have to contribute towards the bankruptcy. So if you have decent income, or if you think it's going to be going up, a consumer proposal would be, in many cases, a superior alternative to a bankruptcy. You can lock in the payment. You know exactly what you're going to have to pay for the term of the proposal.
That's super helpful. I mean, one thing I find interesting about your business is that you have an entire podcast dedicated on helping people not become your clients. We can see it in the background. Your Debt Free in 30, which again, I think is fantastic that, you obviously share your kind of insights and experience to kind of help people not kind of get into these situations.
Yeah, I mean, I guess I'm kind of like the dentist who says you should brush your teeth 3 times a day. Well, isn't that, against their self-interest? Because then nobody will ever go to the dentist. And the answer is, look, there are people who get into debt problems through no fault of their own. And we've certainly seen that here in 2020 with the whole COVID thing and people losing their jobs. And so my job is, I'm not here to judge you. You got into trouble. Let's see what we can do to work your way out of it. Most of the people who contact us don't end up doing a bankruptcy or a proposal. They end up perhaps refinancing their house, getting a second mortgage, using a HELOC, or maybe they end up picking up a part-time job, or cutting their expenses. So we go through all of those different options. But for some people, the formal surgery is required, and that's where the bankruptcy or the consumer proposal come in.
Okay, so it sounds like this is not your business is not somewhere you go if you want to necessarily, bankruptcy. If you're not at sort of that extreme case, you can actually help people with their finances, potentially restructure them to avoid both bankruptcy and consumer proposal, which I think is super interesting.
Yeah, which is why when you call us up, we go through all the different options. Let's work out a budget so we understand where your money goes. And in a lot of cases, people go, yeah, I didn't realize I was spending that much on this thing. And this is something that has become very obvious to a lot of people during the lockdown.
Yeah.
So, because a lot of people are going, wow, you know what? I'm not going to the coffee shop. I'm not going out for dinner. I'm going to the grocery store and cooking and making my own food. There was a lot of money I spent that perhaps I don't need to spend as much in the future. And I've talked to a lot of people who said, boy, I got a lot more cash now than I thought. So there have been people who have been decimated by the lockdown, but there have been other people who perhaps are able to work from home. Their income hasn't been impacted, but their expenses have gone down quite a bit. So those are the kind of things we talk about, because maybe there's a solution for you on your own. If not, then again, we explain all the options. I am required by law, before I sign the piece of paper for a bankruptcy or a proposal, to explain all the options and do a full and complete assessment. So that's what we do. I want you to understand what you're getting into, and I want you to make sure it's the right option for you.
That's fantastic. Now, maybe if we can kind of rewind the clock a little bit, if you can kind of maybe give us an idea of what your business was like kind of pre-COVID. Who were the people that were, coming into your office? Were they renters? Were they homeowners? Kind of what did sort of things look like on your side of the business prior to, March, whenever it was, 15, when we had a state of emergency declared?
Yeah, pre-COVID, and even, now, July 2020, we are not seeing hardly any homeowners. So the vast majority of our clients are renters. So we actually publish something called the Hoyes Michalos Homeowners Bankruptcy Index, and you can do a search in Google for that. It's on our website. And every month we update it to show the percentage of our clients who own a home at the time they file a proposal or a bankruptcy. And if you go back to 2011, the number was somewhere around a third. So about a third of our clients owned a home prior to filing a bankruptcy or consumer proposal. And the reason they were filing the insolvency was because the equity in the home wasn't enough for them to refinance it or sell it and pay off all their debts. There was a very little amount of equity, so probably they were doing a proposal, keeping their home and moving on. Well, if you take a look at the last 2 or 3 years, the
Mhm.
percentage has dropped considerably, because if you bought a home, as you know, in
Mhm.
2010 or 2015 or whenever it was, it is most likely worth a lot more today than when you bought it. Obviously, there are, exceptions to that rule. I guess if you bought right on May 1st, 2017, or whenever the last big peak was, perhaps you could be underwater. But the vast majority of homeowners have significant equity, so they're not becoming my clients. And in fact, if you look at the month of June of this year, our homeowners index was very low. It was like, 3 or 4%. So virtually nobody who is a homeowner is filing an insolvency. The typical person is the typical Canadian. So their income might be around, $2,500 a month, something like that. I mean, if you look at the numbers, the issue for our clients is it's an income problem. So comparing 2019 to 2018, the income of my clients, the average client, has actually gone up. It was up about 5.5%. But it's not because they're getting big raises. It's because more prosperous households were becoming insolvent. So it's kind of like 2 years ago, the guy making $39,000 a year was becoming my client. Last year, it was the guy making $43,500 a year becoming my client. So your expenses have been going up. The cost of servicing that debt has been going up. So even though your income has been going up, you're still getting into trouble. And that's the typical person who we are seeing. They've got an income problem. They are not generating enough to pay the costs. And certainly to live in a place like Toronto, rent, every type of living expense has been high, and that's certainly put the squeeze on them. The
Mhm.
typical person we deal with has just under about $60,000 worth of consumer debt. And the problem is that, again, when you look at the numbers, and I've actually pulled them up here, the cost to service that debt, well, they had about $264 available to service their debt. When you take off, living expenses and rent and groceries and everything else, well, of course, to service $59,000 of debt, that's nowhere near enough. You need closer to a couple of thousand a month. So there's just that massive shortfall in their income and expenses each month, and that's why they end up coming in to see us.
So you mentioned a lot of stuff that's raised a lot of questions for me. Let's focus first on maybe like the renters, sort of the most dominant segment of your client base. Now, you say that it is an income problem, but you have clients who are making 30, 40 plus $1,000 a year with $60,000 in presumably unsecured debt. So I'm kind of curious, like from what you see, what gets people, I mean, that's a lot of debt. I mean, I can imagine how people kind of get that much debt that's not secured by an asset. So what do you think kind of pushes some people to that point where they've just accumulated that much debt that they need to, they come to your office because they can't service it anymore?
In a lot of cases, something has happened. So the typical sequence of events would be I graduate from college or university and I've got a massive student loan, which is a very common thing that we see. So you're starting out behind the 8 ball. Now, I'm a pretty old guy. I'm sure I'm much older than you are, John. I mean, when I went to university in the 1980s, which seems like a millennium ago, I guess it was a millennium ago, the tuition was $1,000 a year at the University of Toronto. It was no
Mhm.
big deal. I could get a summer job at minimum wage and earn enough to pay my tuition and buy my books, and my parents helped with my living expenses, and all was good. Well, now that same degree at the University of Toronto is going to have, I don't know, $16,000 a year in tuition and all the living expenses and whatnot. There's no way at minimum wage you can earn enough to pay for that kind of education. So
Mhm.
unless your parents have a lot of money, you're getting a student loan, which means you're graduating with a big student loan.
I
And
see.
then the jobs, as soon as you get out of university, may or may not be there. You may end up having to take an internship. You may have to be doing contract work, not permanent jobs, not with the benefits and so on. When I graduated from university, I went immediately to a big accounting firm. It wasn't an issue back then. A little
Mhm.
harder today. So I've got this debt. I've got high living costs, but I'm not earning the income to support it. So that's kind of the starting point. And
Mhm.
then for a lot of my clients, something has happened. They lost their job. They got downsized. They got sick.
Mhm.
They got injured at work and were off work. Perhaps they got divorced, because separation obviously creates significant financial problems. So you throw a couple of those things into the mix, and what do? Well, you use debt to survive. And it's not like anyone goes out and says, well, I better borrow $60,000. The only way you can possibly have that much debt is if at some point you were a good credit risk and the lender decided to lend you that amount of money. So things were better and now they're worse. That's what makes personal insolvency so crushing, because things have gotten worse. If you've never had any money in your entire life, you've always been, poor, if you want to use that term, well, I guess it's no big deal. You don't know anything different. But for my clients, things were going better and then they got worse. And, frankly, I think for the vast majority of people, if you had a major life event, like, you got sick and you were off work for 2 years, that would probably pretty seriously impact your finances. I realize in Canada, we've got free medicine and all the rest of it, but free healthcare. But you throw a shock like that in and it's devastating for a lot of people. Losing your job, getting divorced, all those types of things certainly contribute to it. So that's usually what's brought them to my door.
That is interesting. Just hearing you kind of set it up, obviously a lot of people, as you say, are kind of getting into the job market with a lot of debt. And you're right, it doesn't take a big event. We spoke with Carrie Taylor, who's a personal finance blog, who you're familiar with. And it was interesting because she had talked about how when she was in Toronto, she had to move, 5 times in 5 years. And basically every time she moved, it cost her almost $10,000. And that's, I think, a good example of how, even something as simple as getting kicked out of your apartment can add a significant shock to your expenses, and potentially kind of push some people kind of over that edge. And I think probably we're starting to see, obviously, the effects of these things now with this slowdown. Now, when we look at the people who you mentioned own homes and are less likely to be your clients. Now, I'm kind of curious, is it the case that these homeowners were so fantastic at sort of managing their money and great, responsible borrowers that they just did not accumulate enough debt, or were they able to just bundle this sort of any excess spending into their home by refinancing it? So I guess my question is it the fact that homeowners aren't coming to you? Is it just being hidden by the fact that home prices keep rising? So even if they do accumulate debt, can they just refinance it? Or are they in fact just better spenders?
Well, it may be both, but I think it's the latter. So, what's the old saying? In a bull market, we're all geniuses, right? If the stock market's going up, I can pick a couple of stocks at random and they'll probably go up. Well, and again, you know better than I do, but the real estate market, certainly in places like Toronto and Vancouver and most of Canada, has been in a bull market for the last, 10 or 20 years. So if you bought a house in, 2010, pick a day, is it possible that that house is worth less today? Like, is there a place you could have bought a house in 2010, 10 years ago, that has actually gone down in value? Maybe yes, maybe in Fort McMurray, maybe there are some isolated pockets. But is there any area in Toronto that you could have bought a house and over a 10-year period lost money? I don't think so. No. So does that make you an astute investor, or does that make you lucky? Well, you pick. I'm not gonna comment on one or the other, but I think that's basically been it. The homeowners who end up filing an insolvency with us, and it's a very small number, but they tend to have higher unsecured debt than non-homeowners. Not surprising, right? If I own a home, I'm more able to qualify for a credit card, an unsecured line of credit, other forms of debt, because of course, even though it's an unsecured debt, there is still this house kind of notionally backing it all up. So I think a lot of homeowners have, been lucky. And again, I'm not going to, say that it's pure luck, because a lot of them probably, consciously thought about it and said, yes, I am going to buy a house because I think it will be a good investment over the next number of years. And they have been proven correct, which is why I worry considerably about any kind of weakness in the real estate market, because it has been papering over some of these other issues. We have been using our homes as ATM machines. Oh, I've got $50,000 worth of credit card debt. No problem. My home went up by $200,000, so I can just refinance and pay that off.
Mm-hmm.
That will not be the case if home prices are not going up, if they're
Mm-hmm.
stabilized,
Mm-hmm.
or if lenders decide to restrict what they are willing to lend against. And again, you know this better than I do. CMHC continues to tighten up the rules.
Mm-hmm.
HELOCs perhaps are not as easy to get as they used to have been. So that will certainly put pressure on people who are homeowners but do have unsecured debt.
Interesting. So now what have you seen in your business since COVID? I mean, we of course are seeing this big shock in employment and incomes, people getting a lot of support from the government. So what have you seen in terms of sort of insolvencies and consumer proposals over the past 3 months?
Well, they've crashed, they've cratered. So if you look at a chart of personal insolvency filings in Canada, they peaked around 2009, September of 2009 to be specific. And again, we all remember the credit crisis of 2008. The government changed some of the bankruptcy rules that came into effect September 2009. So that was the peak. And then the number of filings continued to fall all the way to bottoming out around 2017, 2018. They peaked up. They started to come back a little bit in 2019, and they were running fairly strong in January and February of this year and the first half of March, and then boom, everything stopped. So the most recent stats we have from the government were for the month of April. The government, the federal government, the Office of the Superintendent of Bankruptcy tends to publish statistics about 2 months in arrears. And for the month of, May of this year, Ontario consumer insolvencies declined by 44% compared to the month of May last year. Bankruptcies were down by 59%. Consumer proposals were down by 35%, which again isn't surprising, as we already discussed. The reason you would file a consumer proposal is you have income that you want to protect, which means you're still working. So the people who are still working are the people who are filing insolvencies. So the reason we've seen this roughly 50% drop in April and in May, and I suspect we will see the same in June and probably in July and August when the stats come out, is that I don't need the protection from the bankruptcy process. I've still got all the debt, but I've got a deferral on my, car payment, mortgage payment, credit card, and the courts are basically closed. They're starting to reopen now, but you're not getting a whole lot of collection activity, certainly not legal collection activity. The collectors themselves have been somewhat dormant because they're all working from home, a little harder for them to do their job. CRA hasn't been doing any collection activity. So all the pressure is off at the moment. So the only people who are calling me are people who are still working, and we know that we've got significantly higher unemployment at the moment. So my business is down roughly 50% over the last 2 or 3 months, and I expect it will be relatively slow over the summer months as well. If the economy is starting to open up by September, then I think that's when my phone will begin to ring again.
Okay, so it sounds like a lot of this decline that you're seeing it sounds like a lot of it is just driven by the fact that people just don't have to keep up with their debts right now, is what it sounds like. I mean, because I can't, like, is obviously for a lot of people, I mean, lost their jobs, are on CERB payments, you know what I mean? And they're getting some income. I mean, I certainly can't imagine that's enough to sustain an individual. So it's not like they're flush with cash, but it sounds like they can just delay their debt obligations. And is that the main thing that is resulting in this decline?
Yeah, it's not the amount of debt you have that's the issue. It's can you service that debt? And if you don't service that debt, what happens? So if I said to you, I owe $1 million, you go, boy, that's a pretty big number. And I said, yeah, but no, I own a $10 million house and it's $1 million mortgage. Okay, well, I guess that's not so big a deal after all, right? And I don't own a $10 million house, just in case you're wondering. But it's the pressure that causes people to file the insolvency. So yeah, my income's way down. I'm not able to make my credit card payments. Maybe I'm throwing a couple of bucks at it, but I can't even make my minimum payments. I'm behind on my car payment. Maybe I've had to defer my mortgage payment, but it's not causing any consequences immediately. If it was a year ago and you stopped paying your credit card, then you're getting a call from the credit card company. And a couple of months later, you're getting a call from a collection agency. And if you wait too long, well, then they're taking you to court, taking legal action, suing you, trying to garnish your wages. Well, they can't garnish your wages if you're not working, and they can't get a wage garnishment if the courts are closed, because they, you know, it's a legal process. And if the collectors aren't calling, then again, that pressure isn't there. So there's a problem. We can see the problem on the horizon, but I don't have to worry about it yet. It's like if I said to you, well, John, we're going to have a wicked thunderstorm 3 days from now.
Yeah.
Okay, well, I'm not carrying my umbrella around today. It's a problem that we know is coming, but it's in the future. So we're not reacting to it immediately today.
So if we think about that and extend this out to tomorrow, what does tomorrow potentially look like? And maybe we'll look at sort of the two groups separately. If we think about people who are non-homeowners, are you expecting a spike? Like presumably once banks no longer allow deferrals on credit card payments or any other debt obligations, is that going to result in a spike in insolvencies among renters?
I assume so. And I don't have a crystal ball, so I don't know for sure, but my guess is what we are going to see, it's not like the light switch is turned on and everyone's going to be back to work immediately. I think it's more like a dimmer switch where gradually more and more people go back to work. So I think your typical office building in downtown Toronto, they'll say, okay, 20% of the people can come back. We got to have physical distancing. And then gradually, as you know, the incidences of the virus go down, then we have more and more people coming back, which means now the food zoo in the big building can open up again because there's enough customers. And you know, the hair salon in downtown Toronto can open up because people are down there again, and the gyms can open up. So more and more people are working. Right now, I think the biggest impediment to the economy reopening is daycare. Because if the schools aren't open and if daycare isn't available, then I've got to stay home with my kids. It's as simple as that. So my guess is that these problems will gradually be alleviated. So by September, October, November, I don't know when it will be, people will start to hit the tipping point. It's once you're back to work, and if the creditors are able to take action against you, that's when you need to take some action. So I don't expect a massive spike in insolvencies on Labor Day, but I do expect that the numbers will continue to build throughout the summer, into the fall, into the winter, unless we have a second wave and everything gets shut down again, then all bets are off.
So you expect insolvencies to rise, at least in the context of potentially renters, over the second half of this year and leading into the first half of 2021?
Yes, I think that's accurate. I mean, I made a prediction on my podcast at the end of December that insolvencies would increase in Canada 20% in 2020. Well, I'm probably going to be horrifically wrong on that one, even though my prediction was looking pretty good the first couple of months with this massive downswing. Obviously, there's a lot fewer happening. Will that all pick up massively in the fourth quarter, the third quarter? I guess we'll see. But yes, I think you've accurately characterized it that compared to last year when the numbers for June, July, and August are released, they will be a lot lower. But if you look at the numbers, April, May, June, July, August, September, they are going to be, I think, gradually creeping up so that perhaps by the fall, we're pretty close to where we would have been, and we may actually see a spike at that point if there's a lot of people who need to file insolvency. The big wild card is there are a lot of people who have lost their jobs, and those jobs will not be returning. The restaurant is closed down for good and will not be reopening. So if I'm a chef at that restaurant, unless I can find another job, I'm not going back to work anytime soon. And I think that'll keep a damper on insolvency statistics for quite some time to come.
Interesting. So turning to homeowners, you know, one thing that we've been hearing about, of course, in the news a fair bit is the percentage of households who are deferring their mortgage payments. You know, I think it's over 15% now. And one concern among a lot of people watching this happening is what happens in the fall once the deferrals are over. I mean, they obviously can't go on forever. And like you said, we find out how many jobs are permanently lost, or at least lost kind of for the short term. How does this impact the housing market in the next 6 to 12 months? Or let's say, forget the housing market. How does this impact those homeowners who've been deferring their mortgage? Are you expecting a similar kind of rise in insolvencies for homeowners as we move ahead?
Yes, would be the short answer to that. And again, I think it's a delayed thing, because if I'm a homeowner, so let's say I've got a deferral on my mortgage payments until September, just to pick a number out of the air.
Mm-hmm.
Okay, so in September, maybe I've got a bit of money and I can start making partial payments, or maybe I got to call the bank and say, look, I need another month or two. It's not like if I miss that first non-deferred payment on September the 1st, the bank is foreclosing on my house.
Mm-hmm.
There's no way that can possibly happen. Obviously, there's a time period in the process, but obviously mortgage lenders don't want massive inventory either. So
Mm-hmm.
I suspect that they will still be as lenient as they can be for a period of time. But I also suspect there's a lot of people going, you know what? I don't have a job, and my job prospects are not good. So I know I can't afford this house. I might as well put it up for sale and sell it. That's one
Mm-hmm.
category of person. And hopefully I can get something, pay off my debts, and maybe I'm good. The other category will be people who are living in the core in Toronto who say, well, now that I'm working from home and my bosses said I can do it forever, why don't I go and move to Kitchener or Owen Sound or somewhere where real estate prices are a lot less? So that presumably can put some downward pressure on real estate prices as well. Again, I don't know. I'm purely speculating. You know more about this stuff than I do. However, your question is, how does that impact insolvency rates? Well, I guess there will be people who will say, you know what, I'm cutting my losses right now. I'm selling my house. So if we are in an environment where real estate prices are going to either stay stable or go down over the next year, I guess the people who take action quickly, sell their house now, they get what they can get for it. They may be able to deal with their unsecured debts and not have to worry about insolvency. The people who continue to hang on, if things do not improve, are the ones who are going to have the greatest problem, because of course at that point they do end up losing their house if they can't pay for it, and they've got all the other unsecured debts as well. What's amazing in my business over the last 30 years, when someone comes in to see me, it's very common that they're, a couple months behind on their credit card payments. They haven't paid their taxes, maybe haven't even filed their taxes. But almost everyone is always completely up to date on their rent or their mortgage payment. That's something that comes out automatically first of the month. It's a pre-authorized payment. Very few people are ever behind on that. It's going to be quite interesting to see over the coming months whether I start seeing more and more people who are actually behind on their rent or mortgage payments, which is something we've never really seen ever.
Interesting. So when we think about homeowners and the potential for them to, be in arrears on their mortgage kind of after the deferrals are over, I wonder how much of that is going to depend on what's actually going on with house prices. I think you had kind of just touched on in your answer. In an environment where prices are flat or down, is there a greater risk of more people kind of coming to your door? Whereas house prices are going up close to 10+% a year. If that continues into the fall, are we going to just go back to kind of the trend that you were sort of seeing pre-COVID, which is a declining rate of homeowners kind of becoming insolvent because of the rising prices of their values of their homes?
Yeah, you're right. And that's really the question. And it's not, do house prices go up? It's, do people think they're going to go up? That's the key, right? It's perception. It's not reality. It's perception. So,
well, why do you say it's perception? At the end of the day, house prices have to go up for them to get that equity.
Right.
And I agree, confidence is part of it for sure.
Yeah, whether I make the decision today to sell my house or not is depend on my perception of the future. So, maybe things are good or bad today, but if I think they're going to get better, then you're right. That makes me hold on. You're absolutely right. Ultimately, facts matter. but it's perceptions that matter more. So my understanding, and again, you can correct me if I'm wrong on this one, but people who have invested in condos to rent them out are typically in a cash flow negative position each month. So I buy a condo with 5% down or whatever, the mortgage payment, the condo fees, maintenance, all the rest of it is not enough, is not as big as it's bigger than the rent I'm getting every month. I'm losing money every month on that condo investment. Why in the world would you do that? That's not an investment. An investment is not something you have to put in $500 every month. Well, the answer is, my perception is, my belief is that in the future, that condo will be worth more and I'll be able to sell it and make money. So if as a homeowner, times are tough now, but I'm pretty sure prices are going to go up, then okay, I guess I hang on. My understanding is we've seen some weakness in the rental market, meaning rents have gone down. And I've heard this from many people I've talked to, that, yeah, I live in this apartment building or this condo, and the unit across the hall from me is now going for $200 a month less than what I'm paying. So I talked to my landlord and I said, hey, dude, I'll either stay here, but you got to give me a $200 break, or I'll move across the hall. Well, a lot of landlords are actually saying, fine, I'll knock a couple of $100 off your rent. So if rental rates are lower, does that not make it easier for me to justify renting instead of owning? Does that not make it easier for me to decide to sell my house and move on? And I understand owning a house is not just dollars and cents. I got a dog and a cat and 3 kids and a spouse and all the rest of it. And I like to paint the walls green, so I want my own place. But money does factor into it as well. So there's a lot of uncertainty and volatility coming up. I don't know what's going to happen with the real estate market, but yes, it will definitely have a significant impact on what happens in my world.
Yeah. It's interesting because as we talk about this, I feel like it is a bit of a chicken and egg kind of scenario where you don't know what comes first or what leads to what. I mean, one narrative, of course, I think probably the one that's CMHC's is that, there's going to be this arrears cliff. People are going to need to dump their homes, and that's going to push prices down. And then this other argument is, well, no, people are not going to, even if they want to sell their home, they're not going to dump them because they have equity. And if the market's busy and prices are going up, we're not going to have this crash. So, and again, part of our discussion is, and our whole summit is trying to kind of think about what are the things that we're going to be looking for in the future. And I guess from what you're saying, you tend to agree, and I think I agree with you, that house prices seems to be in some ways like an important metric to kind of keep an eye on, I would think, in the fall, and listings inventory to see if we start seeing some pressure from homeowners.
Yeah, and my perspective is different than everybody else's. I mean, you're a business person, but you're also an academic. You've got a lot more education than I do, and you're continuing to study and all the rest of it. I look at this not from a macro point of view as to what's going to happen to the economy, because I'm not smart enough to figure that out. I look at it from the individual person's point of view. So if someone is sitting across from me, well, you can't sit across from me anymore because we're all distance, but if I'm having a Zoom conversation with someone, I say to them, okay, let's go through the options. What's your job situation right now? If it's relatively stable, then there's less pressure on you to do anything. But if you're in an industry where, well, I've been able to hang on, but I'm not optimistic about the future, then that would lead one to perhaps decide to sell their house to reduce risk. There's still some equity in it. Why don't I cash that in? Now, of course, the flip side is what's your monthly cost? So are you able to own that home for more or less than what you would be renting for? If you've owned the home for 10 years and the mortgage is substantially paid down, even though there's a lot of equity in it, well, maybe it makes sense to just stay there because rent perhaps is a bigger number. But the opposite could actually be true. So what is your specific situation? What do you see coming down the pike for the future? I think Canadians have always had the belief that home ownership is a good thing. It is the foundation of every financial plan. You want to retire with a fully paid for home. You need much less of a pension when you retire. You need much less in your RSP when you retire if you have a fully paid for home so you can live rent free. You pay the property taxes, you pay the maintenance, and that's it. yes, that makes perfect sense. But I think there has been, or is starting to be, a bit of a mental shift now with people going, well, maybe renting isn't such a bad thing. Maybe I don't want to incur that risk. When people come in to see me and, we're talking about a proposal or bankruptcy, they go, well, I don't want to do that because I don't want to damage my credit because I want to be able to buy a home someday. That's a really big thing for them. And I go, well, if we do the proposal now and get rid of all your debt and you're actually able to start saving, then a few years from now, you will have a down payment. You'll be able to repair your credit and you'll actually be able to buy a house. So real estate is still very prominent in the minds of everybody I meet with, most people I meet with, including the non-owners, the renters, because that's their number one goal in the future is to own a home. But a lot of the people I'm talking to now say, but you know what? I know that's realistic. I know that a 500 square foot condo in Toronto costs $1 million and there's no way I can ever afford that. Okay, well, why don't you just start saving money, deal with your debt, start saving money, and then you can do whatever you want. When you've got cash in your pocket, you're completely flexible. So I think more people are adopting that mindset than I've seen in the past.
Why do you think there isn't, and we're kind of going on a tangent now, but you raised it, and I think it's an interesting question, as much, like, why do you think there are people who just are not as motivated to, try to make renting work for them? Do you think it's just, obviously just psychological, wanting a place of their own? Is it financial? They see kind of rising house prices. Like, what do you think the kind of the key things are for your, the people that you see who are not kind of trying to make renting work for them?
Well, I think it is primarily psychological. So let's do a survey of everybody who's watching, by a show of hands, how many of your parents owned a house? Well, probably a pretty big number. And so when you were growing up, that was a thing. And if your parents didn't own a house, if you lived in substandard rental accommodation, then what's your number one goal? To own your own house. See, so it doesn't matter what your background was, owning a house is a thing. And if you are 25, 35, 40 years old and all of your friends own a condo or own a house, then there is massive social pressure on you to be doing the same. And we've all heard the saying, well, you're just throwing your money away if you're renting. You're paying someone else's mortgage. You should be paying your own. Okay, perhaps that's mathematically correct, but I always try to go back to the numbers. Let's actually crunch the numbers here. What's the opportunity cost of taking your down payment and investing it as opposed to putting it in a down payment? And then what are the actual full-in costs of owning versus renting? For a lot of people, owning is the correct answer. Again, a spouse, 3 kids, a dog, a cat. I want to live in a certain school district, and I don't want. I mean, you talked about Carrie Taylor's experience where the landlord said, "Oh, guess what? You got to move." Well, if I own the place, I don't have to do that. So there's a lot of, non-financial reasons for owning. I think, though, that people are actually starting to think about some of those things now, which may or may not have some impact. Now, there's no doubt that money is a big factor. You look at house prices, if there's no way I can possibly afford it, then I guess I better start justifying why renting is a better deal. And so I think if more people start renting, then that will mean more people start renting. It becomes a snowball. My understanding is in Toronto, there's a whole bunch of Airbnb units. And my understanding is at the moment here in July of 2020, they're not being used as Airbnb units. So what do I do if I'm the owner of that condo unit that I was, renting out under Airbnb? Well, either I guess it goes into the long-term rental pool or I sell it. My perception is that Airbnb won't be coming back. Well, if you put a lot of units in the rental pool, if that drives rental prices down a bit, then that makes it more attractive for people to rent, which perhaps makes it easier for them to psychologically justify renting as opposed to owning. Because we make decisions based on emotion and then justify them by the facts later. Why did you buy that car, John? Well, it's because, the gas mileage and the safety. No, it's because you like the color. It's because it says turbo on the back. It's because there's a place to put your coffee mug. And I think home ownership is certainly very ingrained in our psychology. So if we start finding excuses to rent as opposed to own, then that may certainly become more prevalent.
Interesting.
Or I could be totally wrong. Who knows? I'm the insolvency guy here. You don't want to be coming to me for real estate advice. I'm just telling you what I'm seeing at my side of the desk.
So on wrapping up with sort of this last question on insolvencies, are there any like leading indicators that you keep an eye on that might give you clues into what insolvencies might look like in the future? Or are there none? Is it just, your kind of just experience that's telling you?
Yeah, we are in such a fast moving environment now that I could give you some nonsense about, inflation and unemployment rates and this and that. But frankly, nobody has a clue. And anyone who tells you what they think is going to be happening 3 months from now, it's a wild guess. I mean, the weather guys can't tell you whether it's going to rain this afternoon or not. So how can something as complex as the economy be predicted well in advance? I mean, I can tell you what the insolvency rate will be 2 weeks from now, because I know how many phone calls I'm getting today. But if we have a vaccine, then I guess the economy opens up really quickly, assuming we can deploy it everywhere. And if we don't, I guess it's slower. If we have a second wave, that totally changes everything. So there are so many different variables here that it is really impossible to come up with any kind of accurate projection. So again, talking to an individual person, I say you should be protecting yourself regardless of what's going to happen. So don't try to make a decision based on, well, I'm pretty sure this is going to happen. Well, okay, if the real estate market goes up, how does that affect you? What would you do? If it goes down, what would you do? If you lose your job or don't lose your job? I mean, I happen to think we're in a deflationary environment right now. Is that going to continue for a long time? I don't know, but I know that having debt during a deflationary environment is not a good thing, because you're paying back your debt in more valuable dollars, which sounds counterintuitive, but I think the math holds. So okay, so my advice to people is reduce your debt. And it doesn't matter if house prices go up or down. It doesn't matter if you lose your job or not. Having less debt is generally better than having more debt. So that's kind of the way I think through the process.
That's awesome. We're going to finish up with just 2 last questions we're asking all of our speakers. So our theme for our conference this year is Smart Caution. What does smart caution mean to you?
Well, I think it's what I just said. It means being prepared for whichever event happens. I'm not placing all of my eggs in one basket. I'm not saying, yes, I know for sure real estate is going up, so I'm going to take advantage and buy 4 more condos today. It's being aware that things can go up and down. And I think this has been a fantastic lesson for everybody. I think we've all learned a lot with what we've come through over the last few months. So be prepared for whichever way it could go, because what you don't expect is probably what's going to happen. There was not one single politician in the federal election last year who was talking about pandemics. They talked about a lot of other things, but not this. Every single person missed it. And yet that has had the most dramatic effect on our lives this year. So don't expect that just the way it was yesterday is the way it's going to be. Chances are it's going to be completely different.
Yeah, that's awesome. And the last question is, would you buy or sell a home right now?
Obviously that's a question that has many different variables to it. I personally don't own a home. I live in my wife's home because I'm a business owner. And so I have no assets. She owns everything. So I guess from that point of view, no, I wouldn't. But again, I think if I was buying it as an investment, I have no idea what the answer to that question is. I would call you up and I'd say, John, what do you think? Is stuff going up or not? If I was buying a home to live in, then yes, absolutely, I would buy a home. I think of a house as a consumer good. I don't think of it as an investment. And I understand historically they've been good investments, but I think of a house exactly the same way as I think of a toothbrush. It is something I buy and I use it, and then I throw it away and I get another one. And I realize you don't throw a house away, but over a 50-year period, yes, you do. You have to replace the roof and the furnace and the carpeting and everything else. So it is something that, it's a consumer good. So would I buy that toothbrush? Would I get value out of it? And if the answer is yes, by buying that house, I'm in a good school district for my kids. I don't have to worry about moving. There are some very good reasons for doing it over and above whether it's a good investment. Then yes, absolutely, I'd buy a house.
Awesome. Doug, thanks so much for your time today, for all of your insights. Super helpful. I learned a lot. I'm sure viewers learned a lot. So thanks for taking some time today to speak with us.
Great to be with you, John.